Well, Boku was founded really on the realization that out there is the world's largest connected community, and that is the people having mobile phones. But the problem is that all of those mobile phones are somehow isolated, sort of balkanized into individual mobile network operators. And it doesn't make any sense for a merchant just to connect to one of those operators in one country. What they need is to be able to come to somebody like Boku who can give them one connection to connect to many mobile network operators to make that a useful community to whom to connect. And that's what Boku does. We connect some of the world's largest digital brands, people like Apple and Microsoft and Sony and Spotify and Facebook and Netflix. We connect them through to the mobile network operators of the world with a single, simple connection. And the application that we provide to those merchants right now is to connect to the carrier's billing system to help them to be able to buy things. Now, we present very much as a sort of a billing or as a payments company, but the job that those merchants hire us to do is really to help them to acquire new users, and that's proved to be sort of pretty effective. And so one of the sort of key performance indicators we use is our total payment volume, or TPV, and we've really been motoring in the course of 2017, processing in excess of $1.7 billion through the platform.
So our 2017 results were really exciting for us. So we managed, through growth in our App Store business and growth across music and subscriptions, to generate 3x our 2016 TPV. So our TPV for the year was 1.7 billion compared to 0.6 billion in 2016. And that enabled us to report very strong revenue numbers. Our revenue numbers for the year were up 42% at $24.4 million. And what comes with that is that benefit of all of that scale is our ability to buy much better in the market. And so what's happened is our cost of goods has come down, both in absolute terms, but also in per unit terms. And what that does is that improves our gross margin performance. Our gross margin for the year of $22.1 million is up at 91% relative to 81% in 2016. So what you see is a business growing very, very nicely. We're a payments company. We've built to scale, and now you're seeing the effects of that scale coming to bear in our financials. At an operating expenses level, we run a very tight ship. Our operating expenditure on an adjusted basis is better in 2017 than it was in 2016. And some of that is because we've moved some of our key engineering operations into our Mumbai facility. So we're delivering more for less cost. And our operating costs on the adjusted basis were down at 24.5 million for the full year in 2017. So what that means at an EBITDA level is we're able to show EBITDA losses that have come right down from what was $12.3 million in 2016 down to $2.3 million in 2017. Net losses on a reported basis are 28.1 million. However, that includes $18.6 million of costs that were purely related to the IPO. When you strip back the IPO effects on our numbers, our underlying net loss of $7.4 million compared to $20.6 million in 2016 was an improvement of 64%. From a balance sheet perspective, we closed the year with a strong cash position at $20.2 million. And that was net of paying down some of our working capital. So our debt position has improved dramatically since the IPO. So our debt on a short-term basis has come down from 6 million down to 2.4 million. And also the convertible notes that we were carrying converted to common stock at the IPO. So overall, our debt position has improved down from what was $21 million in 2016 down to $2.4 million at the end of 2017. So we think the net impact of all of these changes is a business that's in a much stronger position to fund future growth. We've got strong revenues. On a run rate basis, our gross margin is now covering our costs, so we are rapidly reaching a point where we are EBITDA positive and also heading in the direction of becoming free cash flow positive. That puts us in a really strong position to be masters of our own destiny and fund future investments and future growth. So there are basically a number of parallel growth curves that are happening that are fueling the growth that we're seeing in our revenue line. Firstly, you've got the sort of underlying secular trend, which is people that are consuming more stuff digitally. So whether that be video, streaming music, downloading data storage, etc. There is a kind of long-term running trend of people consuming more digital content, and clearly we benefit from that. Secondly, as we take, what we do for our customers is we take them into new markets and help them bring on new customers. And so as we roll out new markets for each of our clients, that brings on new clients, and those clients bring on new revenue and new TPV. And then thirdly, so you've got layers upon layers of growth curves. The final one is that each time we put a new carrier live for one of our clients, within that there's a discovery growth curve. So it takes time for people to discover the payment method and to start using it. So we found that some of the carriers that we put on live for the app stores back in 2016 are still seeing monthly growth. So you've got growth curve upon growth curve upon growth curve. And you can see that in our user numbers.
Yeah, I mean, for many of our customers, I mean, the real decision that they're making is, will they implement carrier billing, or will they implement some other form of alternative payment mechanism? And they're really asking themselves, what's the return that they're going to get from investing one of their most precious resources, their engineering talent, where are they going to get more bang for their buck? So the biggest piece of competition that we have is really from other alternative payment providers, the likes of PayPal or Alipay or domestic schemes in particular countries. And it's not that we sort of compete head to head with them, it's really we're asking our customers to believe that they will acquire new customers if they integrate Boku. Clearly there are some other people that do the same thing as us. But the route that Boku has chosen is to try to be the scale player. And so we are several times larger, certainly than any sort of quoted competitor that's in the environment. And that by having that scale really gives us tremendous advantages. The scale on the one hand allows us to support a cost base that gives the broadest level of function and thus helps us to acquire more merchants. And those merchants in turn generate so many transactions that despite the fact we have a higher cost base, we have far and away the lowest cost per transaction on the marketplace. So we're tough to compete with. I mean, you can't compete with us on function because we've probably got it. And if we haven't, we've got 80 or so engineers who can build it for you very quickly. And you can't compete with us on price because if you do, we've got the lowest cost per transaction out there in the marketplace. And that's really helped us with quite a few wins in the course of this year, both developing some of our existing customers, but also with new wins with people like EE in the UK switching their Google business to Boku, and indeed MTS in Russia doing the same. And they were happy enough to report that they're seeing, as a result of the technology embedded in the Boku platform, increases in excess of 30% from just switching over onto our platform. Right now, we do integrate to the carrier's billing system, but your mobile network operator can do a lot more than deduct charges from your prepaid balance or send you a phone bill. They also know kind of who you are very often, where you are. They know something about your type of device. And that type of information can be really useful in other parts of the e-commerce value chain. For example, maybe it could help you to just fill in forms if you consent to allow somebody to use the information the carrier stores on file. Maybe it can help simplify your process if you're having to prove your identity because you can sort out your utility bill that people generally don't carry a utility bill around with them, but those banks do seem to want to ask for one when you're opening an account. Or alternatively, maybe it helps with the process of delivery, knowing where you are. So we think that we can do a lot more than just integrate into the carrier's billing systems, but to really take advantage of the full suite of information that carriers know about you. And it's one of the things we're seeking to develop, are new products in the area of authentication, of registration, and also location-based services. Current trading as we step into 2018 has been strong. I'm pleased to say that all of our non-financial metrics have been growing fairly strongly. In fact, the first quarter of this year we processed just over $725 million worth of TPV, which represents a 160% increase on the same period last year. And in addition, the number of monthly active users also took a bit of a leap. So we were up to 9.2 million users from the 8.1 that we reported at the end of December. Now, all of these things sort of feed through to a respectable financial performance, and we will continue to expect to be EBITDA positive going forward, as we reported in our previous trading statement. And then, also I think you can see that as a management team that we are confident that we'll be able to meet market expectations, both in respect of our revenues and our overall EBITDA projections. And you can also expect that we'll be looking to try to bring to the market new products, both in the billing area and also the non-billing areas that I talked about earlier on, to do with authentication, registration, and location.